My name's Nate. Welcome to the DivMan channel. Today we're going to talk about swing trading, and we will talk about a dividend-paying fund. But today I want to talk about how to play the upside of the market and the downside of the market when the market is really comfy and it's overbought, and when it's oversold, when there's a huge dump in the market. There's a swing trade that you can do with an ETF. You don't need to use options. Options are kind of risky with VIX, particularly because options are often zero-sum games where you could lose everything on your options call. Whereas if you trade an ETF, you might lose 50-70%, but at least you can get a lot of your capital back if you need to. So that's kind of the advantage, a little less risky. Here is a dividend fund that, sorry, not a dividend fund, an ETF that follows the VIX. And this does the inverse of the VIX times 1, so it's unlevered, but it is an inverse, so it does the opposite of the VIX. What is the VIX? The VIX tracks the volatility of S&P 500 options, not the actual index itself, the options on the index. And options are pretty darn, all over the place. They change constantly, and you can lose everything there. And so options are the most skittish iteration of tracking what's happening with the S&P. So with this fund, inverse levered 1x short VIX, what this does is when there's a spike in the market or a spike in volatility with the S&P, so usually what that means is the S&P is dumping. You would see something like this. Here is July 31st, and between July 31st of last year and August 5th of last year, it lost like $20 a share. Now, I don't recommend buying and holding these for the long term. This is a swing trade play. That means you buy for a short period of time and then you sell. I would recommend that you set a take profit level of, if you're going to scale up the amount of profit you want, scale up the number of shares. Don't get greedy because it's hard to predict how much the recovery is going to be. But just to show you what the recovery looks like, $19 a share on August 5, this would be like your buy point. When it dumps that severely, that would be in this strategy's, thesis, you buy at that point. Because look at what happens almost always when it dumps that severely. Usually when the VIX spikes crazy like that, it does recover. And remember, we're doing the opposite of the VIX with this fund. So the VIX eventually slows down, and this fund that shorts the VIX ends up climbing. So you would be able to swing trade at any point. And these days you could set your set profit level at any point once you buy here or buy somewhere around here. And then look at what happens. You can easily make a few bucks a share. And if you have a decent amount of capital, you can make that into a really decent profit. Now, this isn't the only fund to play when the market dumps. As you can see here, this is ProShares version. This is SVXY. Same thing. July 31st of last year is at $59, and then on August 5th, it dumped all the way down to $39 per share. And then almost immediately you see this reflection here. Why? Because the chop in the VIX went away. Usually happens. Maybe not always, but you can usually count on a pretty decent percentage return. And so set a conservative kind of take profit level. Like, what are you really confident the VIX, or SVIX in this case, is going to recover? And just set that level. Don't get greedy. Just like, what do you want out of this? And then just set your level and don't even look at it. Just let the automation take its place. Take place. You may also want to do a stop loss. So you may want to do, if it goes the complete opposite direction, like imagine, for instance, like if August 5th was not the bottom of that dump in the S&P in the summer of last year, you may want to set a a stop so that you don't lose more money, because this is, this could get crazy. I don't recommend using a lot of money doing it, but it is an awesome way to just collect a few bucks. Now the other side of the volatility trade, this would be the side to play when the market is doing well. And so when the market is doing well, you could buy a share of this particular fund. And what happens is when the market dumps, you do want to have a take profit. So like look at like the 3-month period. You can see each of the dumps that have happened in the market. This fund is positively correlated with the VIX. So when the market dumps, specifically the S&P, this fund goes higher because the VIX goes higher. So as you can see here, when the market is normie, like December 6th, the market was doing really fine. January 24, the market was doing fine. These would be buy points, as you can see, like when it seems to be like going down, 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 down. And then you're just waiting for a point like right here. You want to do a conservative take profit level with this fund. This fund is the VXX iPath Series B S&P 500 VIX short-term futures. You don't have to use this one. There's plenty of positively correlated VIX ETFs, but this would be a fund you would buy. Not a huge position. We don't know how this is going to play out, but based on kind of what usually happens, you can usually get your money back. You do this is a little bit of a longer hold sort of a thing, but every few months the market has like a very bearish day, and that's usually when you're going to hit your take profit level if it's conservative. You may also want to put a stop on this. You may want to put some level where you're okay with the loss and you just want to take home your money. So you can do both a take profit, so that's if it increases to the set level you want it, and a stop loss if it keeps dumping, you want to get out of the trade, right? So you can set both of those. That way you've thought through ahead of time, what am I comfortable collecting profit of for this trade, and what am I comfortable losing if it goes wrong, right? And if you think that out ahead of time, you psychoanalyze how you're going to feel about that if that happens. Don't use margin on this. Do not use margin, okay? You could lose your lunch. Only use like straight up capital that you have, or like if you have a very conservative margin position, maybe, but don't use margin with this. That's dumb. Nevertheless, there is a long play that you can do with the VIX, and it's a dividend paying fund, and it's pretty consistent. It's got like a 5-star Morningstar rating. That felt weird. And this is a fund that a lot of dividend investors know about. This is one of the first like high yield dividend funds, SVOL, which is by Simplify. If I just show you like the 1-year chart, you can see a similar 1-year kind of picture to those VIX funds I was showing you. So you see August 5. When you see the fund drop like that, it is probably going to recover. Now, as you can see, there's definitely like a trend line diagonally down as far as the NAV goes, the share price per share. So just keep that in mind. It is also paying a dividend every month of about like 20-ish something cents. I'll have to look at that in a sec on Seeking Alpha here. But you could do the same swing trading, kind of situation, and it is very consistent in getting to some price near its originating price. Each time there's a dump. So when this fund dumps, you can set a conservative take profit level and you'll probably hit that. Just to show you what the dividends are with this fund, it's got like a 16% yield currently. Remember, the yield is the either existing 12-month dividend payments. Let's see, that's the total of that divided into the fund price. I can't really think through which is the denominator and which is the numerator in this, but basically it's amounting to about, this is about 27 cents, and it has been dropping. The yield has been about 30 cents per share. This is because some of the dividends are coming from treasuries and bonds and stuff, and with the interest rates higher, there's a higher, monthly dividend. But even with the dividend of like 26 cents per share, you could definitely buy and hold this fund. You could buy when it dumps, and then you can just continue to hold while it pays dividends. And if you feel comfortable, you can take profit at some point, and the NAV will likely have recovered significantly since your buy point if you bought when it dumped, when the market dumped. So yeah, it's a pretty good fund. Definitely a safer fund for buy and hold. They do have, some diversification in their holdings. They hold like the S&P like outright, I think. They've got some great videos online about how they run things. So wanted to keep it a little bit dividendy because of just, this channel is about dividends. So hope that helps. I just want to show you like my own like playing of this fund. Like I'll just show you what I did. Like on the January 27, I bought 4 shares of this the SVIX fund. This was at $24.71, and then I set my take profit level at $25, and I ended up making that the same day, right? So that's what's cool about these funds. Like you might hit it the same day. Who knows? Watch your day trades if you don't have 25K in your account. So yeah. Anyway, like and subscribe. Hope this was helpful. And yeah, this is a kind of unusual territory for me as well. That's maybe why I'm a little less, I don't know, gung-ho about this than like most dividend stuff that I talk about. But that's all I have to say today. Have a good rest of your day.